You've been here before. Not this exact market, not this exact year, but you felt this kind of stillness. The charts look calm. The headlines are upbeat. Analysts on TV laugh about soft landings and resilient economies. Your watch list has a few dips here and there, but nothing that makes you sweat. It feels safe, and that's exactly what makes it dangerous. You know from experience that markets rarely crash when everyone is already scared. They crash when everyone feels untouchable, when traders stop checking risk, stop asking hard questions, stop paying attention to the signs that don't fit the narrative. And the biggest sign right now? It's not in the S&P 500. It's not in the NASDAQ. It's buried in a market most traders barely glance at, the bond market. You probably think of bonds as boring, slow, safe. They're for pension funds, retirees, conservative portfolios. That's the illusion. The reality? The bond market is the plumbing of the entire financial system. It's where governments, corporations, and banks get their oxygen. If those pipes clog, nothing else works. And here's the part that should make you uneasy. History shows that some of the worst market crashes didn't start with stocks at all. They started with debt. They started with the quiet tightening of credit. They started with yields moving just a little higher, spreads widening just a little too far, liquidity just a little too thin. You can almost hear it now, that faint hum in the background of the market. It's not screaming yet, it's whispering. And those whispers are about debt levels at all-time highs, yield curves sending historic warnings, liquidity pockets drying up, and central banks caught between fighting inflation and keeping the system from snapping. This isn't about predicting a date or guessing a headline. It's about understanding that the next big crash, if it comes, might not look like the crashes you've seen before. It might start in the most boring corner of finance. It might give its first warning in a chart most retail traders have never studied. And if you're not watching, you'll only know it's real when it's already too late. This is your wake-up call. Not to panic, not to run for the exits, but to sharpen your awareness. To see the bond market not as a footnote, but as the heartbeat of the system. To recognize that in the calmest moments, the seeds of chaos are often already planted. Because when the bond market starts cracking, it doesn't just hurt bondholders. It bleeds into stocks, currencies, real estate, everything. And the traders who survive aren't the ones who predict the exact trigger. They're the ones who see the storm forming before anyone else feels the wind. Chapter 1. The calm before the storm. You wake up, open your trading screen, and everything feels quiet. Too quiet. The stock market is holding steady. The headlines are cheerful. Analysts on TV are grinning, pointing to another record-high close. Your watch list isn't bleeding. Even the volatility index is sitting low, almost asleep. But deep down, you feel something you can't quite explain. It's not fear, not yet. It's more like the sound of a distant train whistle, faint, far away, but steady. A warning that something is moving toward you, even if you can't see it yet. This is how the most devastating market crashes often begin, not with chaos, but with calm. A deceptive, almost hypnotic period where traders relax, portfolios swell, and everyone convinces themselves that the good times can't end. But you've been around long enough to know that markets rarely explode without whispering their intentions first. And when the crash finally comes, it's often triggered by something most retail traders never bother to watch: the bond market. You see, while the stock market dances in bright colors under the spotlight, the bond market works in the shadows. It doesn't shout, it murmurs. It leaves clues in yield curves, in credit spreads, in subtle shifts in investor behavior. And if you're not paying attention, those clues pass you by until they become screaming sirens. The danger is that most traders have a mental blind spot for bonds. You think of them as boring, safe. the domain of pension funds and insurance companies, not fast-moving, adrenaline-fueled traders. But that's the exact reason crashes can be born there, because nobody is watching with urgency. And yet the bond market is the plumbing of the entire financial system. It's where governments borrow, corporations raise capital, and banks balance their books. If the pipes crack, the water doesn't just stop flowing, it bursts out and floods everything. Stocks, real estate, currencies, all get soaked. But here's the catch. The cracks don't appear suddenly. They start as tiny stress points. A little extra yield here, a small liquidity squeeze there. It's subtle enough that even seasoned traders dismiss it as noise. You scroll through your charts, you see a blip in treasury yields, and you move on. After all, it's just a few basis points. How dangerous could that be? The real danger is that these small moves often come at the end of an economic cycle, not the middle. And by the time the average investor realizes that bonds are screaming danger, it's already too late to react calmly. You think back to 2008. The news cycle told everyone that the crash was about subprime mortgages. But where did the pressure start building? In credit markets. Liquidity dried up. Bond yields and spreads started flashing red months before equities broke into freefall. The same thing happened in 2020. Corporate bonds began seizing before stocks fell into freefall. The calm period before a crash is like sitting at the edge of a frozen lake in early spring. On the surface, it looks solid, but below, the ice is thinning, weakening, waiting for the right moment to crack. And the bond market is the faint groaning sound you hear beneath your feet. Right now, you're asking yourself, could it be happening again? Could the next big market shock really start in bonds? That's exactly the question you need to keep alive in your mind, because traders who are lulled into thinking only equities matter are the ones who take the biggest hits when the debt market starts to unravel. This is the calm before the storm, and you're standing in the middle of it. The question is, will you hear the first raindrops or only notice the downpour when you're already drenched? Chapter 2. Understanding the bond market's true power. You've probably been told, in books, in news articles, in trading forums, that the stock market is the ultimate barometer of economic health. That's the surface-level truth. But deep down, beneath the flashing tickers and Wall Street drama, it's the bond market that quietly calls the shots. You need to understand this, because once you do, the way you interpret every chart, every macro headline will change forever. Stocks are the flashy cousin. Bonds are the family patriarch. And like any patriarch, they don't need to speak loudly to get their way. The bond market is massive, far bigger than equities. Global stock markets combined are valued at roughly $110 trillion. Impressive? Sure, but the global bond market? Over $140 trillion. That's sovereign debt, corporate bonds, municipal debt, mortgage-backed securities, and more. A sprawling network of promises to repay money, all of which function like the nervous system of the economy. When interest rates shift in the bond market, it's like the central control panel of the financial world flicking a switch. It ripples outward, influencing everything from mortgage rates to corporate borrowing costs to stock valuations. And here's the twist that most retail traders miss. Stocks often follow bonds, not the other way around. When bond yields start climbing or credit spreads widen, stocks eventually take notice. It just takes time. That lag is where you, as a prepared trader, can gain a psychological and strategic edge. Think of it like an earthquake. The bond market feels the tremors first. Stock traders, drunk on bullish momentum, ignore them until the floor starts shaking beneath their feet. Why does the bond market have so much power? Because it's where governments finance themselves. It's where corporations go when they need money to expand, refinance, or survive. It's where banks park massive reserves. If these channels get clogged or toxic, everything dependent on them starts to suffocate. Imagine oxygen being pulled out of a room. At first, nobody notices. Everyone's still talking, still working, still moving around. But slowly, discomfort creeps in. Breathing gets harder. Panic spreads. That's how liquidity stress in the bond market works. It starts invisible and ends in chaos. And the psychology is dangerous. Traders have been conditioned to believe that bonds are safe. The phrase risk-free rate, when referring to government debt, has been drilled into financial education for decades. But that's not entirely true. And in certain conditions, bonds can be the most dangerous asset in the room. In fact, when you look back at history, many major market collapses didn't begin with a stock sell-off at all. They began with a bond shock, a sudden spike in yields, a loss of confidence in debt repayment, a liquidity freeze in credit markets. Stocks were just collateral damage. You think of 1994, the so-called Great Bond Massacre. The Fed unexpectedly hiked rates and global bond markets went into freefall. Trillions in value were wiped out, and stocks soon followed. Or 2013's taper tantrum, where merely hinting at reduced Fed bond purchases caused yields to spike violently. That wasn't even a real crisis, but it still rattled every asset class. And here's where the psychology of the bond market gets even trickier. It's not just about yields going up or down, it's about why they move. Sometimes yields rise because the economy is improving, and stocks love that. But sometimes yields rise because debt holders demand higher compensation for risk, and that's a sign of deepening distrust. You must train yourself to hear these shifts in tone. The bond market speaks a different language than stocks. It talks in spreads, in duration risk, in forward rate expectations. You don't have to master every technical term, but you must know enough to recognize when the conversation changes from calm to concerned. The power of the bond market isn't in sudden drama, it's in quiet control. A change in bond sentiment can force central banks to act. It can crash currencies. It can make once-safe companies unfinanceable overnight. And by the time equity traders realize what's happening, the wave has already hit shore. This is why you can't just watch the Dow, the S&P, or the Nasdaq. If you want to survive and even thrive in the next market crash, you must keep your eyes on the debt markets. Because when the bond market decides it's time to tighten the screws, there's no escape hatch for equities. And the first real whisper of trouble, that often comes in the form of an innocent-looking curve on a chart, the yield curve, which means your next step is learning how to read it before everyone else hears the alarm. Chapter 3. The Inversion Whisper. You've seen it before, even if you didn't pay much attention at the time. That strange chart with two lines representing short-term and long-term interest rates, the yield curve. To most traders, it's just another piece of economic trivia. But to those who've survived multiple market cycles, it's a weather map for financial storms. Normally, the yield curve slopes upward. Why? Because if you're going to lend money for 10 years instead of 2, you expect a higher return. That makes sense. More time means more risk. But when the curve flattens, or worse, inverts, where short-term yields are higher than long-term yields, it's not just odd, it's the bond market quietly saying something's wrong. An inversion is not a random fluke. It's a signal that bond investors believe short-term risks outweigh long-term ones, that the economy might slow, even shrink in the near future. It's the equivalent of the captain of a ship whispering to the crew that they might want to check the lifeboats before telling the passengers anything. And here's the eerie thing. Yield curve inversions have preceded every single U.S. recession since the 1950s. Not most, not some, every single one. That track record should terrify you, because it means that when this whisper turns into a shout, history says you have only so much time before the pain hits equities. The psychology here is dangerous for unprepared traders. When an inversion happens, the stock market doesn't immediately crash. In fact, sometimes it keeps rallying for months. That delay is what lulls people into thinking the signal didn't work this time. They keep buying, they keep leveraging, and then, when the slowdown becomes undeniable, the sell-off is vicious. You might remember 2019. The yield curve inverted that summer. Stocks wobbled, then kept climbing into early 2020. Many dismissed it. Then came the pandemic crash, and while COVID was the catalyst, the underlying fragility was already there. The bond market saw it before the headlines did. Right now, if you're watching closely, you'll notice something unsettling. The yield curve doesn't have to stay inverted for years to cause damage. Even brief inversions can shake confidence in lending, slow credit creation, and tighten financial conditions. That's like quietly draining water out of the pool while swimmers keep diving in. They won't notice until they hit the bottom. So how do you use this as a trader? First, you stop thinking of the yield curve as a macro nerd tool and start treating it like an early warning siren. Second, you don't just watch whether it inverts, you watch how it inverts. Is it driven by short-term yields spiking due to Fed policy? Or are long-term yields falling because investors are scared of growth disappearing? The difference matters. The market's emotional rhythm is hidden in these moves. An inversion driven by fear tends to lead to a sharper downturn because it reflects genuine loss of confidence. An inversion driven by aggressive rate hikes often triggers mechanical stress in credit markets that can snowball into liquidity crises. And here's the part few talk about. When the curve uninverts after being inverted, that's often when the real damage starts. Why? Because by then, the economy is already tipping over. Central banks might be cutting rates to fight a slowdown, and corporate earnings are starting to crumble. The bond market has done its job. It warned you. Whether you listened is on you. The yield curve doesn't scream. It doesn't run through the streets waving red flags. It just changes shape, quietly. And that's why most traders miss it. They're too busy chasing breakouts on their equity charts to notice that the very foundation of market confidence is shifting under their feet. The whisper is there. You can choose to hear it, or you can be one of the many who will claim months from now that no one could have seen it coming. And if the whisper is real, the next stage in this story is already brewing. The slow, dangerous buildup of global debt. That's where the cracks in the system turn from theory into inevitability. Chapter 4. Debt as a Time Bomb. You've probably heard the phrase, debt doesn't matter until it does. Right now, that's the most dangerous truth in the markets. The global economy is sitting on a mountain of debt so massive it's almost abstract. Government debt, corporate debt, household debt. Numbers so big they don't even feel real. Hundreds of trillions. They're just digits on a screen, interest payments quietly being made in the background. Life goes on, markets rise, nobody panics. But here's the problem. The bigger the mountain, the smaller the spark needed to start an avalanche. Debt is like oxygen to the modern economy. Governments borrow to fund budgets. Corporations borrow to expand operations, buy back shares, or simply survive. Consumers borrow to buy homes, cars, even basic necessities. It's the constant flow of borrowed money that keeps the machine turning. And in the bond market, this debt is packaged, traded, repriced, and refinanced every single day. As long as interest rates stay low and confidence remains high, the system works. But the moment rates rise too fast, or investors start doubting whether all this debt can be repaid, everything changes. That's when debt stops being oxygen and starts being gasoline. You've seen it before. In 1997, during the Asian financial crisis, debt levels in emerging markets seemed manageable until capital flows reversed and interest costs exploded overnight. In 2008, U.S. mortgage debt was the trigger. The loans themselves weren't the immediate killer. It was the fact that they were leveraged, securitized, and stacked on top of each other in ways that made the entire financial system fragile. Today, the danger is bigger because the scale is unprecedented. Government debt in major economies is at record highs. Corporate debt, especially in the junk category, has ballooned, and even household debt is rising again in many countries, despite higher rates. And in every case, the assumption is the same. The bond market will always be there to refinance it. But what if one day it isn't? This is where psychology comes in. Debt crises aren't just about math, they're about belief. As long as bond investors believe they'll be repaid, they keep lending. The second that belief cracks, even slightly, the cost of borrowing skyrockets. And when borrowing costs spike, debt service becomes unsustainable. The system starts eating itself. You've got to understand, the bond market isn't polite about this. When confidence fades, it moves fast. Yields can jump in days, credit spreads can widen in hours, and the repricing isn't just about future loans. It immediately hits the value of existing bonds, crushing portfolios and forcing liquidations. And here's the real nightmare. Debt levels are now so high that a rate shock doesn't have to be big to cause trouble. A 1 or 2 percentage point jump in yields can suddenly make entire categories of borrowers insolvent. The math is unforgiving. Imagine you've been carrying a heavy backpack for miles. You can handle it barely. Then, someone tosses a single brick inside. Suddenly, every step is agony. That's what higher rates do to a debt-heavy system. And this isn't just theory. Right now, governments are already facing rising interest costs as bonds issued years ago at low rates mature and have to be refinanced at higher ones. Corporations that binged on cheap debt in the 2010s are staring at refinancing cliffs. Even households are feeling it in credit card rates and adjustable mortgages. This is why the bond market is the perfect place for the next crisis to start. It's not about some mysterious black swan. It's about a completely predictable chain reaction. Rates rise, debt service costs explode, defaults begin, liquidity dries up, and contagion spreads. By the time the stock market figures it out, the fire is already burning through the foundations. And here's the cruel part. This process rarely begins with screaming headlines. It begins quietly, in the pricing of certain bonds, in sudden demand for safe havens, in credit spreads that start creeping wider. The debt is there. The fuse is short. The only question is what lights it. Next, we'll look at one of the earliest and most overlooked signs that the spark has been struck, the slow but deadly evaporation of liquidity. Chapter 5. Liquidity vanishes first. Crashes don't start with fireworks. They start with silence. The kind of silence that comes when a market that's supposed to be deep and fluid suddenly feels shallow. Liquidity is the lifeblood of the bond market. It's the ability to buy or sell a bond quickly, in size, without moving the price too much. When liquidity is healthy, markets can absorb shocks. Traders can reposition. Institutions can rebalance, and even bad news gets digested without panic. But when liquidity dries up, everything changes. Suddenly, selling becomes dangerous. Large trades push prices down hard. Buyers vanish. And the same bonds that seemed like safe, stable income just weeks ago become impossible to unload without taking a big hit. Here's the problem most equity-focused traders miss. Liquidity in the bond market often vanishes before the trouble hits stocks. Why? Because bonds are held by big, slow-moving players, pension funds, insurers, sovereign wealth funds. These institutions don't day trade. When they start quietly pulling back, cutting exposure, or refusing to roll over debt, it's a major shift in the underlying currents of the market. Think about it like a bank run, but for the debt market. At first, only a few insiders notice. Trading desks whisper about widening bid-ask spreads. Dealers start demanding more collateral. Certain bonds don't clear at auction. But the headlines don't catch on because nothing big has happened yet. And then, one day, a large borrower tries to issue new debt and finds no buyers at the expected price. The rates they're forced to accept are far higher than they planned. The market gets jittery. Prices in secondary trading start slipping. Other issuers take note and delay their offerings. That's when the real feedback loop begins. Less issuance means less liquidity, which makes the market even more fragile. Psychologically, this is devastating for confidence. Bond investors hate uncertainty. They don't want to be the last ones holding paper they can't sell. So they start lightening positions, not in a rush, but steadily, every day, like water leaking from a tank. Prices weaken, yields rise, and the mood shifts from complacency to caution. You saw a glimpse of this in the UK's gilt market in 2022. A sudden loss of confidence in the government's fiscal plan caused yields to spike, and liquidity evaporated almost overnight. Pension funds that relied on stable bond prices faced margin calls, forcing them to dump assets in a spiral that nearly triggered a broader financial crisis. The Bank of England had to step in to stop the bleeding. That's how fast liquidity problems in the bond market can turn systemic. And here's the kicker. When liquidity goes in bonds, it doesn't just stay there. It spreads. Banks that can't easily sell bonds for cash tighten lending standards. Companies that can't issue debt cut back on hiring, investment, and spending. Stock investors see earnings estimates drop and the sell-off in equities begins. By the time CNBC starts talking about a stock market correction, the bond market's been in silent panic mode for weeks, maybe months. As a trader, you have to train your eyes to spot this early. Watch bid-ask spreads in major bond ETFs. Track trading volumes in key treasury maturities. Pay attention to failed auctions or sudden spikes in repo rates. These aren't random quirks. They're the early tremors before the quake. And emotionally, you need to accept that these signs don't feel urgent until they are. Liquidity vanishes gradually, then all at once. When that moment hits, it's not just a market event, it's a psychological shock. You'll see seasoned traders freeze, unable to make decisions. You'll hear, "This shouldn't be happening," repeated like a mantra on trading desks. And if you're not prepared, you'll feel that same paralysis creep into your own decision-making. Which is why the next phase is so dangerous. The slow grind of fear. It doesn't explode immediately. It just tightens, like a noose, until the market can't breathe. Conclusion. You've followed the thread. From the quiet whispers of the yield curve, to the mountain of debt that hangs over the global economy, to the invisible tightening of liquidity before anyone else notices. You've seen how the bond market doesn't just influence the stock market, it can decide its fate. Now here's the truth you have to sit with. The next big crash might not start with a shocking headline. It might not start with stocks plunging on your screen. It might begin in a slow, almost imperceptible shift in bond yields, in an auction that clears at the wrong price, in a corporate bond nobody wants to buy. That's why most traders miss it, because it doesn't feel like danger until it's too late. And when the panic does hit, it hits fast. Bond market stress turns into credit freezes. Credit freezes turn into layoffs, bankruptcies, and falling earnings. Stocks finally notice, but by then, the first mover advantage is gone. You're left with two choices. You can be part of the crowd that reacts late, blaming unforeseeable events, or you can be the trader who stays calm because you were watching the right signals all along. This isn't about living in constant fear. It's about respecting the quiet power of the bond market, a market that can force central banks to pivot, crush corporate dreams overnight, and send shockwaves through every asset class you trade. You've learned that yield curves are not trivia, they're warnings. Debt isn't harmless. It's a time bomb when rates move. Liquidity is not guaranteed, and when it disappears, it changes everything. Now the responsibility is yours. You can't claim you didn't know. You can't claim nobody saw it coming. You've seen how the system works, and you've seen where the cracks form first. So the next time markets feel calm, dangerously calm, you'll remember this. You'll check the bond market before you check the stock market. You'll listen for the whispers before the screams. You'll keep your position sizes honest, your stops reasonable, your ego in check. Because crashes aren't about who's the smartest. They're about who's prepared. And when the next storm finally comes rolling in from the bond market, whether it's next month, next year, or 5 years from now, you won't just survive it. You'll see it from the shore before the first wave hits.